In March 2023, Silicon Valley Bank collapsed. $23 billion vanished in 48 hours. Depositors who had millions locked inside could not access their money. The government said everything was fine. Then 3 more banks failed that same month. Then 5 more in the next month. Nobody is talking about it, but it is happening again, right now, in 2026. The banking system is built on a simple lie. The lie is that your money is safe, that banks are regulated, that if something goes wrong, the government will protect you. All 3 are technically true, but the way they are true is not the way you think. In March 2023, Silicon Valley Bank had $209 billion in deposits. They seemed fine. Their balance sheet looked healthy. Then something changed. Interest rates started rising. When interest rates rise, bonds lose value. SVB had invested heavily in bonds. When the bonds tanked, their assets were suddenly worth billions less. Depositors found out. They panicked. They started withdrawing money. Not a little money, all their money, billions per day. Within 48 hours, SVB collapsed. Here is the thing that should terrify you. This was not supposed to happen. SVB was regulated by the Federal Reserve. They were stress tested. They were inspected regularly. Yet they still collapsed so fast that depositors could not get their money out. 2 days later, Credit Suisse collapsed. Credit Suisse was a global institution, a bank that had survived the 2008 financial crisis, the dot-com bubble, every major crisis of the past 50 years, gone in 48 hours. Then First Republic Bank collapsed, then Signature Bank, then Pacific Valley Bank, then Axos Bank had a bank run, then Warehousing Capital had a bank run, then SVB's successor bank had to be rescued. The government said this was contained. They said this was fine. They said there was no systemic risk. But something was already happening. Depositors started moving money, not dramatically, just quietly, moving deposits from smaller regional banks to the biggest banks, JPMorgan, Bank of America, Wells Fargo, Citigroup. The money was flowing toward the places people thought were safest. This is a silent bank run. It is not dramatic. There are no lines outside banks. There is no panic on the streets. It is just people slowly realizing that their money might not be safe and moving it to what they perceive as safer places. The problem is that this creates a vicious cycle. As deposits leave regional banks, those banks have less money to lend. They have to raise interest rates on deposits to attract money. They have to sell assets to cover withdrawals. When they sell assets, they realize losses. The losses mount. Eventually, they run out of money. Then they collapse. Meanwhile, the money flowing into the big banks concentrates financial power even more. JPMorgan's deposits increased by $110 billion in just 2 weeks after SVB collapsed. Bank of America received similar flows. The big banks got bigger. The regional banks got smaller and weaker. Here is what the government is not telling you. The FDIC, the agency that insures your deposits, only has enough money to cover about 1.3% of all deposits in the United States. If even a small percentage of people tried to withdraw their money at once, the FDIC would not have enough money to cover losses. The whole system depends on people not panicking, on people trusting that their money is safe, even when the evidence suggests otherwise. The FDIC technically insures deposits up to $250,000 per account per bank. But if you have more than $250,000, you lose everything above that amount if the bank fails. Corporations know this. They keep their money spread across multiple banks to stay under the insurance limit. But even that strategy has limits. What happened in 2023 was that large depositors discovered they could not get their money out fast enough. They had too much money at one bank, more than the FDIC would insure. So when the bank failed, they lost everything. Some businesses lost their entire operating capital. Some nonprofits lost years of fundraising. The government did bail out the large depositors to prevent complete economic collapse, but the message was clear. Your money is only safe if enough other people do not withdraw theirs. Now we're in 2026. The conditions that caused the 2023 collapses are still present. Interest rates are high. Regional banks are holding depreciated assets. Deposits continue to flow toward big banks, and depositors are more nervous than ever. They remember what happened in 2023. They know the system is fragile. The latest data shows that regional deposits have continued to decline. Credit growth has slowed. Lending standards have tightened. The credit conditions are tightening the same way they tightened before 2008, before 2001, before every major financial crisis. But here is the deeper issue. When money concentrates in big banks, it does not spread into the broader economy. The big banks do not lend money the way regional banks do. Regional banks lend to small businesses, to real estate developers, to local projects. Big banks lend to corporations and wealthy individuals. When deposits flow from regional banks to big banks, small businesses lose access to credit. Real estate development slows. Economic growth slows. Unemployment creeps up. This creates a second vicious cycle. As the economy slows, more people default on loans. As defaults increase, banks become more cautious about lending. As lending decreases, the economy slows more. This is how financial crises propagate. What is happening right now in 2026 is a silent financial contraction. It is not obvious because it is not dramatic. There are no bank lines. There is no stock market crash. There is just slowly tightening credit, slowly declining deposits at regional banks, slowly increasing defaults, slowly declining economic growth. The uncomfortable question is whether this is sustainable, whether the system can continue indefinitely with concentrated money, tightening credit, and declining regional bank capacity. The answer is probably not. Eventually, something breaks. A bank fails. Depositors panic. The cycle accelerates. And suddenly, the silent crisis becomes a loud one. But here is what makes this really uncomfortable. When the next major financial crisis happens, the government response will probably be similar to 2008 and 2023. They will bail out the banks. They will protect large depositors. They will stabilize the system. But ordinary people will still lose. Their savings will lose purchasing power to inflation. Their wages will not keep up with inflation. Their jobs might disappear. Their homes might lose value. The people who caused the crisis will be protected. The banks will recover. The executives will keep their jobs and bonuses. And ordinary people will bear the cost through inflation, unemployment, and lost wealth. The real question is not whether a banking crisis is coming. The evidence suggests it is. The real question is whether you will be protected when it arrives. And based on the system's track record, the answer is probably no.